Thanks so much to the panel. Thanks to all of you for coming this morning. So our topic today is the next frontier of fintech, where the really dramatic, lucrative opportunity is going to be in the future. I think that's something everybody wants to know. We have 3 very experienced practitioners who know a lot about this. I guess to start with, can each of you share a little bit about either your personal or your company's investment philosophy? What kinds of companies do you invest in? What do you, a little bit about what you look for, what you care about, or your values and mission? Jay?
Sure. So again, Jay Reineman with Propel Venture Partners. It's a bit of a startup venture fund that was formerly known as BBVA Ventures. We left the bank in February, and they became our sole LP. There's 3 GPs. I'm one of them. Our high-level philosophy is we want to invest in people we like and believe in. We've got a no-jerk policy. We're a pretty early-stage investor now that we got ourselves outside the bank holding company rules. We're investing in everything that is financial services enabled by tech and tech for financial services. It's pretty broad. We're investing right now out of a $150 million US fund. It's an SBIC fund, so it does come with some extra baggage there. And we're in the process of opening up a European fund. We look globally. We look for companies that are solving big problems. We like to be a good partner to them, so we're trying to be a significant owner, somewhere between 5 to 19% ownership, co-lead, lead.
Very cool.
That's us.
Rohit?
Sure. Hi, Rohit Boris, American Express Ventures. We typically look to invest in sort of early to growth stage companies. Series A through C would be the vast majority of our investments. In terms of objective, the objective is to drive collaboration and partnership between American Express and our portfolio companies. And at the earliest stages, Series A, it's more about helping with product development, sometimes helping them navigate regulatory environment as well, to the more established companies later stages about commercial agreements. Areas of focus, we tend to focus on commerce, so some of the traditional segments of fintech like insurance, mortgage, that's not something we focus on. Commerce, both B2C and B2B, are super interesting for us. We do invest across the globe and have several investments in Europe, Latin America, and Asia as well.
Okay. Will?
Will Kohler from Lightspeed. Thanks for having me. So Lightspeed has evolved into a larger early stage fund. We raised Fund 11 not too long ago. It's a $700 million early stage fund. So the kind of tagline there is, it's hard to consistently generate great returns when your funds keep getting larger and larger. So you have to just kind of rely on a lot of pattern recognition of what's worked in the past. And what's worked for us historically has been enterprise infrastructure. It's kind of been our calling card. And then in the last 10 years, we've really worked hard, and one of our partners, Jeremy Liu, has done a great job building our consumer practice. So within enterprise and consumer, a lot of times those are very distinct practice areas, as we all know. If you think of Snapchat on one hand and then Nutanix on the other. I think the really exciting part of fintech, broadly defined, is in a lot of ways the best companies, or what we look at, sometimes are at the convergence of those two. It's really harnessing the best of infrastructure, whether it's data insights, automated workflows, just some thoughtful way to get this product to be engaging. And at the same time, there's a lot of consumer go-to-market nuances that if you're strictly enterprise, you don't appreciate or understand. So those are where we've seen and continue to look for some of the biggest outcomes. And 80% of what we do is seed A and B, so we're early stage folks. We have raised most recently a select fund to back our pre-existing early stage investments, but it does enable us to look at some unique growth opportunities as well.
So there's been a little bit of a debate here, I think, about corporate VCs versus independent VCs.
Just going to jump right into that.
Yeah. so we have both perspectives.
So we're done with fintech. Let's just get
Did everyone hear that on Tuesday? So there was some fun stuff Fred Wilson.
Yeah, what do you recall of Fred Wilson?
Something
saying?
about the devil. Devil, and the corporates should just buy, not invest. What else? Is there? Dumb money. Fred, amazing investor. He has kind of recanted those kind of comments in the past, but this on Tuesday he was doing a great job.
Give it time.
I mean, and given this audience, also it was a bold move to do. I hate to say I do agree with him with so much of it, though. And for myself, I know we share some investments, Rohit and I.
You can hold hands. It's okay.
Talk each other through this.
I've talked to my therapist about this. No, I've been on both sides. I started this venture path in a corporate world at Visa. I got super lucky to get into a team that had made a bunch of money for Visa back at the beginning of the late 99, 2000, rode that through a little bit. But and then joined BBVA back in 2011. Another classic corporate venture, and I don't know if many of you guys know about this, but like the classic corporate venture profile is that you're investing off the balance sheet. You have a bunch of people that are responsible for finding, hunting, closing, managing those investments. Oftentimes you got your personal reputation on the line. You're doing it because you want to do this. It's fun. But unfortunately, in most cases, it's too complicated to get a structure where you actually have a financial incentive to do great deals. It's a corporate incentive process, and sometimes getting things like carried interest when you have the potential of making more than your CEO or the other top paid executives just messes up HR. It's not, you just can't get there. And that's the traditional, I mean, that's what Will has. I mean, he's got a real structure. He's putting his own money in, and that's, you're completely aligned with the other investors, with the entrepreneurs. When you have money at risk, and you're going to share in the fun in the end, hopefully. Corporates are a little bit more confusing sometimes because they don't necessarily follow those same rules. Unfortunately, there's some turnover that happens because of their own doing. Because if they're a good investor, they go to somewhere where they can get a lot of money, or the corporation says they don't want to do this anymore. So he's got some points. I think there's ways for corporates to solve it, and I think he should have qualified that so that he wasn't blanketing all of them. There's good ones, and then maybe there's others that are still learning how to get it done.
Any thoughts, Rohit?
Sure, definitely. Yeah, I agree. There are challenges. There are issues with corporate VCs, and there are so-called dumb investors. But I say there are dumb investors on the financial side as well. I look at our track record and say that, okay, 2015 was probably our slowest year. We walked away from, I can't recall how many investments. And it seems like the peak in terms of valuation was Q3 last year. So yeah, take that dumb money. In terms of value add, I think every investor, be it a corporate or financial, has to have something that they bring to the table that's more than just capital. Right? Pure financial VCs are making introductions, they're taking active board seats. Corporate VCs have to first figure out what is their value add, and everyone will have a different approach, different mindset. Our value add is about, so we invest ahead of the business units, we help nurture these relationships, and no, we look out for our companies, we look out for our portfolio companies, and investment by Amex Ventures does not give Amex any preferential rights, but it helps convert what would have been a vendor relationship to more of a partnership. And there are definitely benefits to that. I mean, Amex has tremendous capabilities in fraud prevention, data analytics. Even before the term big data was coined, Amex has been crunching away. We probably operate the largest machine learning cluster in the world. And we've been able to help our portfolio companies with data science help and validation of use cases. I think that's...
The two co-investments we have, some of those are fairly early stage.
Yeah.
I can't imagine your back-end corporation would have engaged if you guys didn't invest. I mean, those are both significant up.
Yeah, I guess as the traditional VC, I've lived through this a bit. I was an entrepreneur in the telecom go-go days, and that's when communications companies had a lot of corporate VCs or corporate activity and strategic investing activity. Some still do, but a lot of those have gone away. And I think when there's a lot of corporate investing in a sector, generally that's also a signal that the corporates themselves are in a bit of trouble, or at least see it coming. Because you can't underestimate that sometimes this is a lot about learning. It's not just about, hey, we can help you get from this huge milestone to this other. They're doing it to learn as well. And that really comes down to the decision, I think, of the entrepreneur. And the only thing I would add is, in my experience, early stage, I don't see a corporate investor necessarily setting that company on a different path than they should be able to accomplish themselves. I don't think it's going to fast forward anything. I think you need to have that core competency there yourself. You need to understand what your product is, if customers care about it, how you sell it, how you scale it. And I don't think a corporate relationship in the early days is necessarily going to get you there. Now, Rohit made a really good point, which is getting a traditional VC may not either. I mean, they just may not help you as well. So we're all kind of held to that standard of helping a company in those early stages get to the next point. I think the tagline of corporate usually plays, or at least makes more sense to me, in the later stages, when there is a potential business opportunity or distribution agreement or whatever it is that the company could actually execute on. I mean, it doesn't help to do a distribution agreement with IBM. If you're a Series A company, it will bury your company. And we've all seen this play out. It's like you show up to the board meeting, CEO says, we got IBM OEM agreement. You're like, oh, shit. Like, that's not good. Like, we don't know how to sell this ourselves yet. So I think at the right stage, it's a very valuable potential additive layer of financing along with a business relationship. In the early stage, I do agree with Fred in that you have to be very careful. And then there's the market signaling, there's the focus, there's a lot of things. So I think that's the path we've seen work. And I'm actually seeing it in a company I'm involved with now, where they're a corporate partner with Citi, and they're executing very well on it. But that was a 2-year execution process to get that distribution in place. That's just the reality. So.
Sure. Rohit, did you say a minute ago that you think the fintech market itself peaked last year?
In terms of valuations, yeah, I definitely feel that. I mean, the sort of sky-high valuations that we were seeing last year definitely either have ended or it's shut down. And I think a number of factors for that. There were a number of investors who sort of rushed into fintech in the last few years. A lot of corporate money, a lot of financial money as well, sort of trying to get into what they looked at and saw as the next big opportunity. And yeah, that led to skyrocketing valuations. And I think that valuations are probably cooling down, but not the pace of investments. Investors are probably taking sort of what I would say normal time to do their diligence. This year is probably going to be the most active year for us in the past 3-4 years in terms of number of investments that we would close. But they are the rounds are definitely seem to be taking a lot longer than what we were seeing last year.
So I've noticed that venture capitalists don't like the word bubble, but Anand's group has done graphs that show the trends in fintech investment, and they go up and down, and they went down in the fourth quarter, back up in the first quarter of this year. If you had to project for the rest of this year, what do you think that trend might look like? Overall investment, venture capital, private equity, hedge funds? I
think number of deals will continue to pace well, because I think people are doing, I mean, they're just pushing downstream in the earliest stages. And I would imagine if you talk to people who are running, some of the higher velocity incubator, angel groups, you're seeing more fintech as part of the distribution of types of companies. And it doesn't, the beautiful thing of what we're all doing is it doesn't take much to get one up and running. And at least the perception is the value propositions are there across all fintech. Now, whether that's real or not, we'll see. So I just think you'll see a lot of velocity continue. Actual aggregate investment dollars, I think, will slow down, because I just think there were such big outliers in this sector. You know, you look at some of the larger insurance companies, you know, raising 50 to 100. That tends to skew the gross dollars, but really on a, you know, I think so deals will go up, and I think gross dollars will go down.
I think Q1 was also fueled by some foreign deals, some big Chinese, Asian money. Otherwise, I probably would have been flat. I guess that we should ask Anand. But I would guess I would agree with the panel. I think we're supposed to disagree, but but no, I would, unfortunately. There's, I think from my perspective, there's a lot of low-hanging fruit still. The incumbents, the incumbent industry is still servicing their customers in the retail channels, the physical channels, and just everything that's related to digitizing their businesses needs to improve. And this wave of the unbundling they're picking off every single piece of it, and it's going to just continue.
I do think, though, we're all getting a little bit of insight how hard it is to succeed at scale in this ecosystem. And you're seeing it with, you know, we talked a little bit about some of the lending companies and what they're experiencing at scale. And I think that is now the expectations of the investment community as well as the entrepreneurial community of, okay, what problems am I going to have to solve for 2 to 3 years from now versus what's right in front of me? I think that's coming more to the forefront of conversation. Like, and that didn't happen before. I think people just saw these huge monoliths ready to be disrupted. Let's go attack them. That's the beauty of what we do. And now it's, okay, there's some real issues down the line.
And then maybe we need to partner with them instead, because we need to use the charter
at the right time, because you don't want to take their money too early.
Well, there's just a lot of those neo or upstart banks that, and BBVA bought one of them, which absolutely great company, but I think people realize, or entrepreneurs realize, how hard it is when you don't have the charter, and getting a bank charter right now is not very easy. And with, I don't know what's happening with the Bancorp guys, but I don't see them as much anymore. And I have a lot of respect for it, because they started a lot of this, and you just don't see those guys. And now there's a handful of other banks that are stepping in, but they're much small. They're also very small banks, I'm not sure what kind of technology they have. Their regulatory relationship might not be as good. So those guys as the base of you guys building your businesses doesn't sound so good. There needs to be some other big guys that are going to step in and be the bank for the startups, I think. SVB should be doing this.
Well, yeah, there are a number of banks that have gone into this. The OCC claims it's becoming more willing to consider giving fintechs charters, but they do famously move very slowly. So it may be a while before that actually happens. But do you guys agree? Because there are people in the industry who say, well, you know, all these fintech companies used to all be disruptive challengers. They all wanted to like take, you know, unbundle the banks, as you just said, and that there's some trend toward more collaboration with Chase and On Deck, with BBVA and Future Advisor, with you know, here and there we're seeing examples of partnerships. But I would also suspect if you looked at the ratio of how much that's happening versus how many fintech companies are out there, which I think is around 10,000, that's still a fairly low ratio. What do you guys think? Do you see a trend toward more collaboration, you know, going from disruptors to collaborators, or do you think there are still a lot of disruptors out there that are still building momentum?
We have an investment in a company called Blend Labs, and they work with big banks to, frankly, streamline the mortgage origination process. And I mean, I think it's a very hard technical and workflow challenge to create a solution that can be integrated into that channel at any type of velocity and then show value to them. But that's what makes this company, I think, really cool. But I also think that's why it's a very hard proposition to go and try to supplement how those companies work, get integrated, and the sales cycles, as we all know, are very hard. So it's a certain type of beast that goes and does that and succeeds. But we absolutely believe there's huge and immense value there, because within these large fin services companies, I think there is a lot of desire on their profitable business lines to protect that, and then maybe, you know, abstract out some cost in some of the other ones. On the other side, though, I think just the carrot at the end of the tunnel for becoming a branded play, and if you look at SoFi of the world, it's just so pronounced, because brand in this space just, you know, it's totally changing. I mean, the people who are the ultimate users, we all talk about millennials or whatever, but there's this notion that this has just not been a frequently engaged product in your life. Student loans, I mean, but now that it become part of your life and a brand, and then take it from there and become more of your AUM aggregation, I think it's just such a powerful carrot that we see most people going down that path, versus trying to fight through, you know, the channel.
Sure. Well, so you just brought up mortgage technology. So let's get into the meat of this conversation, which is what are the emerging areas that are going to be really lucrative fields of opportunity. So you brought up mortgage. Jay, I know you've also referred to the mortgage process as ugly, I think. What you see opportunity there as well?
Yeah. There's just so many areas that still that like I was mentioning earlier, that the traditional banks, financial services companies, that mortgage is a very complicated process, and for them to build the technology or to buy the technology to do this 100% digitally is still not very easy. So most of that stuff is relegated to the branches. That should be fixed. This does not need to go to branches, or improve the products that the branch people have to be able to service the customer, so it can be done much faster. Every single complicated product that a bank offers is, I'd hate to say, somewhere probably 90% of it's done still in the branch channel. That's opportunity.
Sure. Now, just to play devil's advocate, there have been cases of startups that have said, okay, we're going to take a difficult problem that banks have and we're going to solve it. And then they bump into all this legacy technology the banks already have, that it's hard to be compatible with lots of banks because they each have different things. Like Standard Treasury is an example where they said, we're going to give banks open APIs, which they can provide to others, and they can open their technology to others and have like almost like a app marketplace model. But they found that going to different banks, each one was so different and had its own like spaghetti, complicated, convoluted IT situation, that it was too hard to try to build one thing that would work for everybody. So they ended up getting bought by Silicon Valley Bank. Now that may just be a strange outlier example, but do you guys have any thoughts on what it would take for a startup to really build something successfully that the incumbents can all just, readily buy into?
I mean, I think the problem of having legacy infrastructure and having to maintain that's not going away anytime soon, and that is a tough problem. And that's why it will be so lucrative for someone who can figure it out. You mentioned Standard Treasury, but there are numerous other companies that have done a fantastic job of enabling sort of API functionality and allowing banks to sort of export data and sort of build applications on top of it. Plaid is a company that comes to mind that has just executed and done an amazing job. So yeah, it is a tough problem, and as a startup, that's what makes it more interesting.
I mean, we in our portfolio, this isn't fintech investments, but they're enterprise investments that are selling to the fintech vertical, and they've been very successful. One of our companies is called MuleSoft. It's getting applications to talk to each other, and they've been very successful in financial services. I just think if you're going to sell in there, you can't try to take on too big a problem at the beginning and try to get all these disparate systems to look at the way you look at the world. So I think there are shared issues, particularly in infrastructure, that a lot of these banks have. I mean, debt collection. It's going to be a huge problem. All the banks are going to suffer from debt collection issues. A lot of it's, so can you figure out a way, versus collection agencies to help them do that? I just don't think you want to take on too much. I think a lot of startups have learned that lesson the hard way, selling into that channel. You got to start somewhere very focused, figure out what the commonality is. And if you can't figure that out early on, just pull back and try to solve something else.
Yeah, that's a good area. And there are a few companies that try to provide something, an app that gives you better communication with the borrowers so that before it gets to like this horrendous 90-day, 120-day late situation, you're communicating with them, you're figuring out what they can pay, you're negotiating.
No, it's 0 to 1. It's like you're a customer or we're trying to extract cents on the dollar. This is not a retaining relationship. Yeah. There's got to be a world in between. I'm sure we all have that little credit blip from that Verizon bill you didn't pay 14 years ago, and it shows up. Like, how did that happen?
There's Kenneth Lee at Debt Buddy has a company that does just that, credit repair. So they kind of walk the customer, tells them what their problem was, and they figure out how to fix the problem on their credit bureau reports and files. So let's talk about other areas. What about emerging consumer technologies? I mean, one thing that's kind of cool is the Amazon Alexa, the Google Home, that having that device in your home that will help you, make appointments, do your grocery list. Potentially, you could do your banking, or you could make payments, pay your bills, or pay somebody else through it. Do you guys see that becoming either a payment or a financial services technology?
Can I ask how many people have Alexas at home?
A few.
Not many. Surprising. We have one. It's great at telling jokes. I think that's the most common feature used.
Does it do it randomly, or do you have
you
to?
can ask Alexa, tell me a joke, and she's got great ones. We use that. Weather. It plays great music. It's a great speaker. But I guess I don't see it. I think I was looking. Alexa has skills, in that there's a marketplace that's being built out where Amazon's opened up this for developers to build on top. I think right now Capital One's the only one I've seen. I don't. Do you guys? Does Amex?
No.
You should, guys. I mean, anyways. But I mean, it's very basic. It's what is my balance? I think maybe you could pay your credit card. I don't think they have payments yet. If you have the mobile app right now, it's so easy to do these things. Maybe I don't know. For me, it's not that big a deal. I'll just stick to her jokes.
I look at Alexa as just part of this broader category of sort of call it Internet of Things or whatever. And I do think that it's going to be very interesting, where Alexa or your car or your Fitbit are all devices that can be used as an identity layer. Users will have the option of choosing what device they want to use to interact. It's not necessarily going to replace your phone. I think the phone will still continue to be the most important device that you would use to interface. So I think there are potential use cases that make it interesting, but not as a standalone. Nobody's going to support do banking only on Alexa, right? You're going to be everywhere, and you want to be where your consumers are. And if they choose to interface with you through Alexa using voice recognition, etc., yeah, banks will get there. If you want to embed payments in your phone, in your watch, or your Fitbit, yeah, you already have those things right now.
Seems like a feature, not a company.
Yeah, exactly. Yeah.
Well, maybe the company's voice recognition, or the category. Because if you have voice recognition, then you could do it on your app, you could do it with Alexa, you could do it in your car, which I want to talk about next. Okay.
Yeah, I think there's a lot of reports coming out now that the number of mobile apps we actually all engage with is few. And if you actually look at the type of content people actually care about, it's it's probably not financial. It's, I mean, Snapchat. I mean, you just look at, like, what do people really want to do day to day? So we have a small investment in a company in town called Cheddar, which is the CNBC for millennials. It's trying to make engaging short form content live about a lot of these trends, what's going on. I just think there's a level of awareness that people don't have about what goes on in the back end of this. I mean, despite everything about Zenefits, they brought to the table this notion of brokerage commissions, and you could actually provide free, awesome software, make people happy, and then you can monetize it. Like, small and medium-sized businesses did not know that existed, and then they're aware of it. I just think consumers are very similar. They haven't really gone in depth on some of these products, services that will protect their lives, that will benefit them, but it hasn't been presented in a way that's easy to use, frictionless, and affordable. So I just think it's a huge awareness of how the systems work. Like, I mean, we all look at wealth management and the robo-advisors. I mean, it just wasn't, it takes a long time to build a brand that, you know, that wealth advisor's charging you 2.5% and we can reduce the basis points, and all you effectively do is get market returns, like one way or the other. Like, so I just think this awareness is the biggest challenge, and where the best companies will really present something that people realize it does impact them, it's meaningful. We're not all going to be crazy and say you're going to engage daily with some of these financial products, but at least make it something that they're aware of. And so I just can't imagine walking into, you know, asking my device about a lot of fintechy type thing. Just, I don't know.
That's fair enough. Well, okay, so we talked about mortgage, we talked about debt collection, talked about home banking, I guess you would call it. What would you say, for each of you, what would you say is like a really interesting emerging area that you're looking at, or actively looking at companies in, or want to look at companies in?
Sure.
In this?
So we've made, and this is totally self-serving, we've made an investment in a life insurance company called Ladder. I think it's fascinating on the theme I just talked about of the data on traditional life and how companies have gone to market with it and sold it isn't good. But as a functional value prop for your life in that 15 to 20 year portion where you're exposed with rising student like education costs, home costs, you should be protected, and you should protect other people in your family. So just like simple, to the point, but very complicated in how you build a company around it. I think the payment structure in the United States is ridiculous, and I know that's a really basic comment, but supply chain financing, the fact that payables take 90 to 120 days for good people to pay good suppliers. I'm not talking about default. That's just like a systematic breakdown of how you buy a good, resell a good, and pay someone for that service. And that is starting to happen now in the on-demand labor force. Like, people are working, and they're working multiple jobs, and they want to get paid for labor that they just provided, but they have to wait. You have to wait. And it just is, there's just so many avenues in the system that has been set up over the last 100 years that are structural. Now, a lot of these are more features than, but so many great companies start by just solving a little problem and getting that wedge and growing it into something bigger. So.
I agree with Bill. B2B payments financing, super interesting. In fact, just yesterday we announced an investment in a company called TradeShift that does that. So very excited about that.
What do they do?
So they optimize and they help companies better manage their supplier payments. There's a lot of inefficiencies out there, and there are many more opportunities on the B2B side. In fact, B2B does not get as much attention as B2C payments, which sort of makes it much more interesting as well. But so other than B2B, what we are focused on, sort of AI messaging, sort of chat-based commerce. I mean, that's not a new phenomenon. I mean, in Asia, it's been used widely for several years, but definitely something that's only now that I guess coming to the US. AI, very interested in that category, and I don't look at AI. AI as just a collection of different technologies, but we have seen tremendous advances in machine learning, NLP, etc., where you can look at AI as one category, but how do you use AI to provide better customer service, right? How can you use AI to do better marketing? Like, there are numerous opportunities out there, and we're very excited about some of the companies that we're talking to.
Yeah, I would say in any of our financial services company where anyone is trying to do underwriting, if we don't see they're leveraging AI or machine learning, there's a problem at this point. It's something we wouldn't look at it. We see a tremendous amount of lending, payments, even on the customer service, the marketing side. We haven't gotten, just in terms of future tech, we haven't gotten so geeky as like the drones or anything like that yet.
And so what?
As drones. And, waiting for the drone to go get my money the 6 times I have to go to the ATM a year or something.
But for insurance, there's drone usage.
For data collection.
Yeah, it's really interesting because you can collect hard-to-get data, sending a drone up in the air and doing appraisals and assessments.
Yeah.
And we have a commercial drone company, and that's the best part of doing this is you don't see that coming. You just know there's a trend, and then who are the people that care? And mining and insurance companies. Who knew?
I just picture a drone hitting me in the head. I want insurance against drones.
You probably should be insured.
Drone insurance. Drone insurance.
That's me.
It's a different kind of insurance. We have life insurance for you, but
there you go. I'm a little old school that way. Let's see if we have questions from the audience. We probably do.
A few questions back here. The first is, do you think partnerships, acquisitions, or IPOs will be the most popular for fintech over the next few years?
If we're, obviously the IPO market's still tough, so I would expect trade, sale, M&A going to be there. Are the incumbents going to be the one to buy? I've got some experience in that, and from a banking perspective, I think the banks should be buying this. They need this digital talent, especially if you can get a real visionary founder group, excellent technologists, because that's hard for banks to get those guys right now. It's nearly impossible. However, that's also extremely complicated because of some of the way that is a risk-weighted asset and what it does to capital consumption. So you gotta look hard, or you need some serious executive support to get through that, plus the regulatory approvals that you may need. I think some larger banks are even probably being banned from doing that kind of M&A right now. But I definitely think there should be more incumbent acquisitions.
So, but partnerships is probably the bigger category.
Probably. Acquisitions seem more necessary.
Any other thoughts?
Yeah, partnerships. We can certainly have more partnerships. I think that's definitely large companies should be partnering with startups and vice versa. In terms of acquisitions, yeah, I think we should see some uptick when, as funding sources perhaps become more constrained, more companies would be looking for exit, and not just from acquired by large banks. I think there are opportunities for startups themselves, the larger ones, to make some of these smaller acquisitions. Coming back to how scale is important, and once you own a customer, trying to leverage that customer relationship and sort of expand into new product categories. Some of the good companies have managed to raise massive amounts of money last year, expecting a slowdown, and there is an opportunity, in my opinion, for some of these smaller acquisitions within startups as well.
I guess I would add a fourth, which is kind of inactivity, wind down, or just not sure what to do next. Like, it's definitely not going to be IPOs. We know that. I wish. There'll definitely be some high-level M&A activity for the really good companies. Partnerships can sometimes sound like, okay, we just figured out it's super expensive to acquire customers, and our origination is what this actually comes down to, and we don't have, or it could be, wow, these third-party cost of capital is drying up because credits are changing, and some of these banks are starting to get some new data that there actually are defaults in some of these lending platforms, and that may slow down. So I just think there's going to be a lot of people who are trying to figure out what to do next after the initial, Series A or seed, and now it's like, okay, go to market hard. And there's just been so much volume that's gone in that I think that'll be the fourth category. And I don't know if that's a partnership or an acqui-hire or a let's just pull back and see, but I think you're going to see a lot of that.
I've gotten a surprisingly large number of calls where a team is saying that their board is asking them for looking for strategic options.
Yeah.
And everything's on the table. Very large companies, like some of the unicorns, to very small companies across the board.
It doesn't feel so strategic when you say that, does it?
It's a code word,
Yeah, no, I get it.
Any other audience questions?
Great. So the next question is, you've all made investments in blockchain. Are you bullish or bearish on new investments in this space?
I was actually going to ask that. So.
I mean, yeah, we are very bullish. I think we look at blockchain as something potentially game-changing. Again, I think it's great that the conversation has moved away from the currency to the protocol. That's how we look at it. But I think we haven't figured out what the sort of killer application or the use case needs to be. How do you take advantage of this distributed nature, which, going back to my telecommunication days, this is similar to sort of point-to-point communication to ad hoc communication, just makes the network inherently more robust and fault tolerant. But for that, you have to have massive scale to see the OpEx savings. And many other definite advantages in blockchain, but the use cases are probably, we haven't quite figured that out. What is the killer use case?
So it's interesting that you're bullish on it, but you don't know what it's going to be used for.
I think that's why
there's potential, right? I mean, then you expect smarter entrepreneurs will figure it out.
Sure. Yeah, well, people have suggested securities clearing, payments, even mortgages potentially.
I haven't done a blockchain investment. We do have one, and I was going to say something, but I think I'm going to latch on to we're bullish about the potential of what we don't know.
Does that mean your blockchain?
That sounded pretty good. Didn't go that route.
Well, it's interesting because there was a question recently: is fintech is the hype exceeding reality? And I would think blockchain is like a perfect area where you would ask that question. But
there's so many things that when you look back 10 years later, so I mean, some of these things just take time. Now, I don't know if blockchain is one of those, but it certainly is interesting with really, really smart people to find out or see what some of the derivatives that are coming out of it. And some of the movement by even large institutions of starting to evaluate this notion of the ledger. So I think now it's easy to say, reality is, hype far outpaced reality, and now here we are, and it's tough. So some of these things just take a very long time, and the derivatives are what spawn the ultimate prize. I mean, or this spawns the derivatives. So I don't know where this goes. I just know there are really, really smart people thinking every day about this, and a lot of capital has gone in. There will be a lot of, unfortunately, not great investments or returns, and jobs lost, which really sucks. But I do think it's just, there's too much focus for it not to end up somewhere. So the hype thing is always hard to,
We have an investment in Coinbase. I am bullish on blockchain with Bitcoin. I prefer open versus closed. So I think I understand why a lot of the financial institutions right now are talking about blockchain, because the regulators and the compliance departments and legal departments of the organizations don't like you talking about Bitcoin because it's potentially scary. But I think, unfortunately, it's the most efficient way of running a blockchain. We know it works with Bitcoins or Ethereum, but when we get to a private blockchain, you have a database. Then I think we have pretty good database technology and security and tokenization. I don't know if the incremental improvements worth it.
Sure. Good. I'm glad you disagree on that. One more question from the audience.
Sure. So this last audience question is for Will. Is there any truth to the notion that traditional VCs only go to corporates with the quote-unquote dogs of their portfolio?
Lovely. Awesome.
Yeah, you know, first, I think I'll try to answer that. But I think it's really important that, and I know this is a tagline for traditional, it is the entrepreneurs, it is the CEO and management teams that are making these decisions. Like, it's not traditional VCs walking around, knocking on, I mean, these are really smart people. Like, if I walk up with dogs and you know what dogs, I mean, that's just not how the system works. These are entrepreneurs who know what is best for their company, know what they need to do for that next round of capital, and who is the best access point for it. So if they decide, you know what, I want strategics, you know, to answer the point of dogs, I mean, VCs accuse other VCs of that. Oh, you know, you know, do you send me your dogs and I send you? I mean, that's like, so I can't answer that, unfortunately, but I do want to stress the point that we are very much just part of the conversation with our management teams of what's the right course of the next round of capital and what the company needs to succeed and who is the best person, team, corporation to provide that. And frankly, we're trying to do the same in early stage deals. So I know that's kind of idealistic, but I just, you know, dogs are, I don't know. Kind of leave it at that.
Dogs are your best friend, aren't they?
What?
A man's best friend.
Yeah.
I love dogs. Well, that was very diplomatic. Any other thoughts from either of you?
No, I think Will said it. I mean, this is a people business, and if you're sending dogs around, that you're going to get dogs back, and so.
Fair. Well, unfortunately, we're out of time. Thank you so much.
Thank you
for
Penny.
being a great panel. I appreciate it.
Thank you, Penny.